Welcome back. You're watching The Money Show with me, Kavita Thapliyal. And let's move on. We are talking about your portfolio. And in your portfolio, it's important for you to have different asset classes. And today, let's also focus on gold. What's the trajectory of gold going ahead after the concerns over inflation and interest rates? Should you be buying gold in your portfolio? Near-term outlook of gold and your strategy. Let's understand all of this. We have G. Chandrasekhar, commodity expert, with us on the show today. Good evening and welcome to the Money Show, Chandrasekhar sir. All right, so let's just first give our viewers a backgrounder of what's happening with gold. You know, on the domestic front, we do have inflation and we do have a scenario where we could see interest rate hikes. But then most importantly, what we heard with the Jackson Hole meeting, where Fed chairperson also said that, you know, they will not bow down from raising interest rates if that's a kind of scenario. Obviously, a lot depends on the data that might just come up in few months. But then what's happening with gold? And when we talk about the shine, do you think in the near term this will again go beyond 2000, or you think it's going to be range bound, where it's a time for an investor to maybe strategize something for their portfolio?
Thank you, Kavita. Because India is not a price setter, but a mere price taker, it is important for investors here to understand the global scenario. Now, in the last 12 to 15 months, as we know, the US Federal Reserve hiked interest rates several times to contain inflation. Despite these successive hikes of interest rates in the United States, inflation is still well above 2% target. The labor market is still tight. It's quite robust. And more important, the private sector demand is rather resilient. And therefore, these have actually encouraged an uptrend in the US real yields, which continues to remain intact, maybe very small changes. The dollar continues to remain strong. The dollar index is slightly above 104, with a possibility of going to 105. And most important, the market participants are pricing in a soft landing of the US economy. Until 4 to 6 months ago, everybody talked about a big recession in the US. It is not coming anytime soon. There is the talk of a soft landing of the US economy. At the same time, look at the demand side. Look at Europe. Europe is slowing substantially, recession in some of the pockets. China is slowing versus the 5.5% GDP growth rate target. China will probably be growing at about 4%. India is no better. Inflation is quite high, unaffordably high for many of the poor people, and it's actually hurting and burning holes in the pockets of people. And that is why speculative investors have exited gold in some measure, and speculative net long positions on the bourses have actually fallen. And therefore, the current ecosystem for gold is far from supportive. Therefore, gold is under pressure, and therefore it is range bound. It is around $1,900 a troy ounce, give or take 1%, maybe 1880, 1920. It'll be in that range.
All right, but then we cannot complete this discussion without talking about inflation and the trajectory of inflation. Okay, talking about India, definitely monsoon is a dampener. The El Nino impact is activated. Okay, talking about US inflation, you know, despite of all the concerns and despite everything trying, it is not exactly at the level where it should have been. In fact, it going up looks much more likely. You know, the household savings have gone down. The credit card borrowing has gone up. So the situation is really not supporting what they were expecting by this time of the year. So let's just focus on the inflation part, and how much do you think the chances are more towards an interest rate hike in a couple of months, maybe in the next policy itself, for India and US?
Yeah, absolutely. In fact, let us look at the Fed chair speech last Friday at Jackson Hole. He has actually, if you've noticed, he has actually raised the bar for further rate hikes. He has not ruled out further rate hikes. He simply raised the bar. That is number one. For the Fed, in my view, will very closely watch growth, we'll watch labor market, and we'll watch inflation. And therefore, interest rates in the US, which is actually the driver of the world economy and the market, interest rates in the US will stay higher for longer. That's the expression they are using. There is one meeting in September. I give it a reasonably small probability of a rate hike in September. There is another meeting in November. The November meeting, I'm sure, holds a slightly higher level of probability for a rate hike. And once that November rate hike happens, I expect a long pause for at least 6 months, possibly going up to April 2024. And any talk of a rate cut, we are talking about rate hike. There will be talk of rate cut. That will not happen until the second quarter of next year, April, May, June, because all this monetary policy, the effect of the monetary policy will always have a lagged impact or a lagged effect. So these successive hikes in interest rate in the US will show themselves up in slowing economic growth, etc., after the first quarter of next year, when possibly the Fed can think of a rate cut. And therefore, when you look at all this big picture, on current reckoning, my view very clearly until the end of this year, I see gold continuing to remain under pressure. It will most likely trade in the $1875, $1925 an ounce in that range. And you talked about India, which is very important. We are arguably the world's large importers and consumers. And if our rupee has faced headwinds, our rupee has actually weakened, but thanks to RBI intervention, it has not weakened to the extent it ought to have under normal circumstances. And that is why my expectation is the rupee will probably trade between 82 and 83.5, or 82 and 84, thanks to RBI intervention. Now, we have to look at the demand side also, which is very, very important in my view. And a lot of people actually ignore the demand side. Physical demand is going to be weak. Physical demand is going to be enervated, whether it is India or China or even Europe to some extent. Physical demand is going to be weak, particularly in India, as you referred to the southwest monsoon. I think it's been suboptimal so far, and therefore inflation is unlikely to decline in a hurry. Rural income growth, in my view, is going to be weak and tepid, and that is going to create demand concerns for gold. And for this is a big picture. And for within this, I think our viewers will need to think about how best to invest in gold and reap benefits. My view, and let me make it clear, I'm not a trader. I don't hold any trading position anywhere. I'm a student of this market, and I speak with a certain responsibility. But I would think the investors should actually buy gold at every dip, but they must have the capacity and the intention to hold on to this position for at least 6 to 8 months, because only 6 months from now, there is a possibility of the gold prices rising towards $2,000 or even slightly go above $2,000. And therefore, buy at every dip is one suggestion, but you must have the clear intent to hold it for at least 6 months, if not more. Then, of course, one would certainly reap good benefits. On the other hand, I would think silver investment today is more likely to give better returns, because
gold
even
strategy.
towards the end of the...
Yes, sir. So let's just get the gold strategy straight for the investors once again. So you can buy on dips, and the time horizon for that should be at least 6 to 8 months. You've got to be patient with the prices, okay? But then, let's continue talking about silver. Silver, you think is shining brighter than gold?
Yes, silver is certainly shining brighter than gold, as you rightly said, because silver is also an industrial metal, okay? And therefore, the world market is actually facing a deficit. That when you look at the supply-demand fundamentals of the silver market is actually in a state of deficit, and plus its industrial application. That is going to lift, in my view, silver prices going towards the end of this year. I will not be surprised if silver touches first and then breaches $25 an ounce, and from the current levels of around 23 or whatever. Yeah, and therefore silver, in my view, has a much better potential for the next 4 months to give better returns to investors.
All right. Now, that being said, could you also talk about the right way to invest in gold right now? Are we talking about waiting for next tranche of sovereign gold bond, or you think buying an ETF or a gold fund makes sense? Because sovereign gold bond is a better deal, you know, also because of the extra return that you get over the market price.
Yeah. No, I would actually pitch for sovereign gold bonds. One can actually, there are so many investment avenues available as far as gold is concerned. I think you need to put money in each one of them. For example, in the overseas market, in the US market, people are exiting ETF. That is again putting pressure on gold prices. But if someone has the intent, clear intent, and the capacity to wait for another 6 months, I think all those various avenues of investment one can look at, but gold bond scheme appears to my mind a much better option.
All right, so that's all about commodities and gold and silver as an asset class, if at all you want to add in your portfolio. Thank you so much, sir, for being on the show and helping our viewers with this today.
God bless.
On that note, let's take a quick break, and post that, let's talk about paying off your home loan. Now, someone who's aggressively looking at paying off their home loan, this is a good strategy for you. And also, definitely, people are really tensed about and worried about the raising EMI. But then how could you strategize paying all your home loan in one go, or maybe in lump sum? What should be the strategy behind it? And also, your portfolio-related questions. All of this getting answered after this break with Gautam Kalia.